Hello, Money Multipliers. Welcome back to another episode of the Money Multiplier podcast. I'm your host, Hannah Kessler, and we ask ourselves, do our dollars make sense? So for my people watching on YouTube, I just got to give a big shout out to my hat. All right, yo girl went thrift shopping this past weekend, and I found this hat, and I was like, if this is not Hannah and this does not scream Hannah, I don't know what else does. So you get it for today on this episode. I love fashion, right? Ever since I've been growing up, I actually, back in the day, wanted to even become a fashion designer. And it is still one of my dreams, to own my own boutique. I want to have my label be called Hannah Nicole, and I want my storefront to be called Aphrodite. So I don't know, ever since I was a young girl, I've always wanted to own one of those boutiques and kind of design my own clothes, like the boho chic type of style. And anywho, I was just out and about this past weekend walking down Beach Street with some friends, and we went into this little thrift store called Moxie Vintage. So for all my folks who come out here to Daytona Beach Shores, Moxie Vintage because it's one of like the coolest thrift stores in town. So anyways, I wanted to get a little spruced up today. It is December. I love the month of December, and it is actually about 3 months away from our live mastermind event that we're doing in Tampa. So Mastering the Money Game Live. You can go and register and snag your ticket at moneygamelive.com, and tickets are now live as of yesterday. They just went up. You can go and snag your spots. We got our GA tickets and then also our VIP tickets, but just anything and everything that you need to know and understand to really master the money game, the systems, the mindsets, the mentors, to then walk away with actionable steps that you can start doing to produce more cash flow and put your little green men to work. So that's the whole purpose of the Tampa event. I'm very excited. This is one of the first events I've ever done of this kind. All of my events that I've thrown was just 100% IBC focused, and that will be back next year. So October 2025, Denver, Colorado, we're coming out to you, baby. The whole team is going to be out there, and that's going to be our annual live Money Multiplier Mastermind event. But not to get it confused with the Tampa event in March that's happening. Myself and Larry Steinhaus, we're going to be co-hosting that. So Mastering the Money Game, go to moneygamelive.com, and you can go and snag your tickets from there. So without further ado, one of the topics that we're going to be getting into here today is, if not IBC, then what? If not the infinite banking concept, then what? What are my other options? And that's some of the topics that we're going to be talking about here today, specifically for my folks who are deep into the whole world of whole life versus IULs versus universal life, and my 401k to my self-directed IRA and all of the different products in between. This is going to be the episode for y'all. So grab your beverage, sit down. Let me tell you, it is the holiday season. And actually, when I went shopping, it was around the Black Friday time, and we went over to Total Wine because I wanted to go and bring some beverages down to my siblings for Thanksgiving. And Total Wine was having a whole bunch of sales, and they're my favorite place to go for sours. So I picked up one of these sour beverages. It is from the brewing company in Florida, actually. Oh, Florida, you brewed this. But anywho's, it's a strawberry and peach sour ale. Strawberry peach sour ale called Ezra the Lion. So anywho's, grab a beverage, sit down with me, grab a snack, and we're just going to chit chat for a few minutes. So let's get into the episode. So we got to make money to live on this God-given earth we call America, right? I got to go out there. I got to support myself somehow. And it doesn't matter how you make your money. I do have a firm belief that you should be in an occupation or money business that does bring you joy It gets you up out of bed every day. You find some passion. You feel like you're helping people, right? But at the end of the day, I don't care how you go make your money. You gotta make your money to live on this God-given earth we call America. And then what do we do with the money? When I produce that money that comes in for me, and side note, this is what Nelson Nash calls is the first business you want to be in, the business that supports your income. The second business you want to be in is the banking business, the business that finances everything throughout your life. And that's what we talk a lot about over here at the Money Multiplier. However, the first business, the one that supports your income. When you go out there and you go make your money, what do you do with it? Well, since day one, I've been programmed to go and leave my money down at the commercial banks because, well, that's where they keep the money. Go open my checking account at Wells Fargo, U.S. Bank, Bank of America, TD Bank, Suncoast Bank down here in Florida, right? You can go put your money into the bank, and then what does the banker do? The banker then uses our money, and they make a good living off of our money. And a lot of my folks, if you've been following me, you understand that point. But there's one place I can keep the money that I make. I can keep it at the bank. Another option, I could leave it under my mattress. I could dig a hole in the backyard, or I could leave it in my sock drawer, right? That's a place that I could warehouse my money. But if I do that, I don't really want to do that, because if I do, then I'm kind of losing out on the hidden tax that we call inflation, right? So that's why it's not one of my most favorite things to keep my money in my sock drawer. Or, another option, I could leave it with a financial advisor, and they think that they can manage my money better than I can. Right? And so a lot of us people, what we'll do is we'll take our savings dollars going down and give it to our financial advisor at the corner local bank and have them manage all of our money for us, right? And they don't got any skin in the game. They're just kind of playing Monopoly almost with our green men. That's our green men. And there's this big story. I'm not going to get into it. I've got into it at one point in one of my episodes where I talk about the pilot who's over in Camdenton, Missouri, where we have the lake house at in Lake of the Ozarks. He's literally there working for survival right now because his financial advisor down at the corner bank didn't do a good job managing his monies over $1 million. And it went to squat zero. So yeah, give up your control to somebody else who doesn't give or care about your money and your financial health as much as what you do for yourself and your family. And all of these are financial advisors. I'm not saying it's a bad thing to have coaches or mentors and different things. You should, but these traditional financial advisors, they're not explaining to you the wealth transfer, the taxes you're paying on those investments, the fees, the 2% that you got to pay your financial advisor. And then also not to mention the lack of the use of the money or the opportunity cost because it's just being stored in one place in that volatile environment. Most likely it's the stock market and you guys are just sitting the money there waiting and just hoping that it grows and hoping that you weather the storm that comes. And it's like, y'all, we got to stop this mindset. I mean, think about it. How well has it been working out for a lot of the baby boomers that in your lifetime about just going out there working, saving their money, putting it into retirement accounts in the stock market? How well is it really panning out for them? So I want y'all to get to think about this stuff. So recap, I can keep it in the bank. I can keep it under my mattress. I can keep it with a financial advisor. I could leave it in a qualified account like a 401k, an IRA, and different things. But as we know, I don't want to keep my money there because number one, I'm locking up the money. And reminder, money is nothing more than just a means of exchange. People do things with money that they would never do with things that money buys. You would never go out and purchase yourself a house or a car and then wait until you're age 59 and a half to drive the car or move into the house. I apparently forgot to put my phone on silent, and it's my best girly friend. Shout out to Miss Maddie's. Anyways, so you would never do that in your financial life. Okay, wait, quick side note here, interruption in the episode. You know what's kind of funny? My phone is on Do Not Disturb, and my best girly friend is just like calling me through. She says, I don't care your phone's on Do Not Disturb and you're recording a podcast right now, Hannah. I need to chat. No, I love my girlfriends. So, I don't want to keep it in a qualified account because I'm locking up my money. That's number one in my priority list. But then number two, I'm exposing it to risks that I cannot control. Because most of the time, and specifically when it comes to like the 401k, which like every single American basically has one, you know, what you're doing is you're putting your dollars away into this 401k account, and then your money is tied to the markets, and that's what's making it go up and go down, and that performance growth. And I don't want to do that. When I'm warehousing my wealth somewhere, I want to store it in a place that has guaranteed a growth and access to that capital. And then through where I warehouse the money is where I go buy the investments. Because a lot of people may not agree with me on this, but when you're talking about 401ks and those other retirement accounts that have the volatility of the market, those are investments in my opinion, even annuities. I mean, I was just talking with a gentleman earlier today where he is losing right now in his annuity because the markets are down, you know? So I believe that an investment involves risk. And when it has the risk, meaning that money can grow, but it can also go down and lose value, that's the risk. It is an investment and it's not a safe place to warehouse the money. I'm not saying stop your investments. Absolutely. Invest in the things that you like, know, and understand. But when it comes to where you're warehousing the money at, the warehouse needs to have that guaranteed control. And through that is where we're going and buying the investment. So some may argue with me, but I do believe that a 401k and those other types of vehicles are investments because they involve risk and they can go down and lose money. So that would be number 4, the qualified investment accounts. Now, let's get into this subject. This is kind of one of the reasons I wanted to make this episode here today. I could leave my money in an IUL policy. I could leave the money in an IUL policy, and I could not do the whole life policy. So I wanted to shed some light because there has been a lot of recent talk about IULs. And I know IULs have been a very main conversation when it comes to the infinite banking concept and the life insurance space. But I just want to do a big PSA to my people. Is that you need to understand the history of IUL policies to even understand why they came out on the market and why they're being solicited by life insurance companies. Because IUL policies, they haven't been around for that long. They've been around and they've been sold since 1997. They started to gain popularity around the 2009 era, but they came out on the market in 97. So get this. That means that they are 27 years old. They're older than myself. But if I compare that to whole life, reminder, whole life's been around even longer than the tax code's been here. Tax code's only been here since 1913, and whole life's been around longer than that. And today, ever since those 20 plus years that this IUL has been out there on the market, they have totally underperformed for its users. And my biggest fear is when new people get into the life insurance space, especially in the day and age that we have TikTok, Instagram, YouTube, and different things. I am fearful of the spread rates and using the indexed loan options. Because here's the biggest thing, y'all. Number one, if somebody is coming to you and they're trying to sell you an IUL policy to be used for banking, in my opinion, you just need to run, okay? It is not to be used for banking. Matter of fact, Nelson Nash talks about his thoughts on IUL on page 39 of his book. He talks about his thoughts on IUL, VULs, and EUL policies. And my biggest fear is that people are getting misrepresented on what a product that it really is. And people don't understand that in an IUL contract, the risk is being put back to the policy owner instead of the insurance company absorbing all of that risk. Because here's the thing about it. In most layman terms that I like to describe an IUL policy is that it's nothing more than just a 1-year term insurance where the cash account on the side gets invested into the market. And it's not even getting invested directly into the market. What's happening is it's going into this fund that then the insurance company invests on its behalf. And there's cap rates to that. You have a minimum floor and you got a cap at the top. And caps, they can go up and they can go down, just like the strike prices and options, okay? Because that's what it is. Essentially, the insurance companies are buying these call options. And for my average person that's just listening to this and they're like, Hannah, I don't even know what the hell a strike price is or a call option is, you don't need to be buying an IUL policy. Again, that's just my opinion. But when you look at the way that these loans are, and you're never paying back those policy loans and you're using it for a banking system, the loan expenses are going to start to compound against you with the cap rate dropping, or in my opinion, I think it's going to remain the same. So what happens, right? Let's just make believe I have a hypothetical scenario where years go on and you're using your policy loans out of this IUL policy and one negative year happens, just one negative year. Because reminder, we are in the greatest bull run that we have ever been in all of history. So in the event when it happens, not an if, when it happens, that one negative year, say I have a $2 million loan that's outstanding, and let's call it a 5% interest rate that the insurance company is charging me. If I have that $2 million loan outstanding, that's $100,000 of just loan interest alone that the policy is going to have to support, along with the cost of the insurance, along with the admin fees, and it's just going to totally blow up on itself because, again, you're putting the risk of that investment back on the insured person and the policy owner rather than the insurance company absorbing all of the risk. And to be honest with you, this has been proven to be true because you'll notice that regulations in the insurance company are coming in and proving this right because they are making insurance companies and insurance agents, they're coming back with these regulations because these companies are totally overinflating and using these hypothetical returns on their illustrations. And it literally says it on there on that tabular detail page, hypothetical returns. And so my people who are getting into this realm of wanting to take back the control of their money, be their own banker, they hear all of this talk about IUL that's out there, but they don't understand what's actually going on. And that's why a lot of my colleagues in the space, they literally have IUL challenges where they said, hey, if you have an IUL policy that's over a decade years old and it's performed better than what was illustrated when you got it on the initial issuing illustration, I'm going to pay you, I think it's like $1,000 he's going to pay that individual if they can show an IUL policy that is performed better than the issuing illustration and it's 10 years plus old. But it hasn't happened because all of these IUL illustrations have been underperforming. And a lot of people that are soliciting, promoting IUL policies, most of the time they're soliciting them to people who can't afford that risk or that renewal cost of insurance expense. Because here's the thing, y'all. If you really look at an IUL policy illustration, look at the guaranteed side of that contract. Look at the guaranteed side of that illustration and watch at ages 60 to 70. Sometimes even before that, if you stop paying your premiums, which for some reason insurance agents love illustrating stop paying premiums. But as we know, as bankers, we love paying our premiums because have you ever made too many deposits into your bank account or your whole life insurance policy designed for privatized banking system? Anywho's, you'll notice that in that tabular detail illustration, the guaranteed side of that policy will start to go down on the cash value and the death benefit will start to go down. And the reason for that is because of that renewal monthly cost of the insurance. If you're not making those returns where your money is being invested into and it's not helping to pay for that cost of the insurance, what's going to happen is your policy contract is going to start taking the money that should be invested and then pay for that cost of the insurance. Or what you could do when you're like 65 years old, you could come out of pocket with like $5,000 a year and start paying your premiums now with that money. You know, just so that then your cash values don't go down and your death benefit doesn't totally deplete on itself. I mean, I challenge y'all, really think for yourself and question when people are coming to you talking about these index universal life policies, because they are not black and white as they seem. There's so much gray area in there, and these companies are just manipulating these illustrations, totally overinflating the non-guaranteed side of all these hypotheticals that they're leading their people on to be. I mean, shout out this one person where she commented on a YouTube video and she says, hey, I got a whole life policy and I have an IUL policy. I've had my whole life policy for 6 years and I had my IUL policy for 3 years. And I will tell you, my whole life policy performed as expected, even better with the dividends. My IUL policy totally underperformed. So when you are hearing people talk about IULs for banking, safely warehousing the money, no. Because here's your first biggest red flag. If people are telling you they're IUL agents and they're saying you cannot lose in an IUL product, you need to totally run away because they have no idea what in the hell that they're talking about. And they're just getting into this for the best mission of themselves and trying to make a commission check. So no, you will lose your ass in an IUL policy. Number two, the renewal cost of the insurance, right? Every month, that cost of the insurance gets more and more expensive because as we get older, the cost of the insurance gets more and more expensive. That's just how it always is. That makes sense, right? And that's the difference too when it comes to the whole life policy. Whole life policy, it has that fixed cost to the insurance. And again, I'm not going to probably get into it in today's episode, but that's where the whole negative mentality of like the Dave Ramsey, Susie Orman people saying, well, whole life insurance is just expensive insurance. Why do I need that? Here's my one question. Why do you buy a house and why do you rent a house? There's your answer. Anywho's, but it has the fixed cost of the insurance. So that's why it's guaranteed, it's locked in, it's fixed, and it's never going to get more expensive. Now, too, with the IUL contract, there is some market involvement. The number thing you want in an asset class is control, and you cannot control the variables that come in an IUL policy. like I said from the very get-go, and I say it all the time that probably you guys are so sick and tired of me hearing about this, but I am never going to tell you how to go make your money or how to go invest the money. If you want to have those buddy conversations, we can, but the whole life policy is nothing more than just where I store and I keep the money. And I'm telling you, it's that stupid simple. Stop overcomplicating this stuff. So my IUL people, it's not too late, okay? There are ways that you can get out of the policy. There are ways that you can educate yourself to know more about what you do have. And I would just talk to people. Get an in-force illustration on that IUL policy that you own and send me an email if you want. Email me podcast@themoneymultiplier.com and I'll give you my feedback on that policy. I do it all the time with whole life policies. I mean, heck, people sometimes even send me term policies if they want me to review for them. I'll do it. So send me an email if you got one of those IUL contracts and you just want to have an honest conversation. And I know you're probably thinking to yourself, well, Hannah, I know why you're on the whole life road because you're Nelson Nash. This is all that you believe in and that you know. And you're absolutely right. It is all that I believe in because it has guarantees because nobody, and I actually had this conversation with my father because I was getting a little discouraged last week. You ever especially for my people who work at home, do you ever just go out and you're at home, you're working in your office and you kind of just feel like a lone ranger sometimes. There's no one here to talk to in the little cubicles, no one to have lunch with. You're kind of just all by your little lonesome, right? And you kind of feel like a lone ranger. And it was kind of getting to me one day where I just saw these comments that were coming in and I'm like, oh my gosh, what is going on? Why are people totally misunderstanding IUL policies? And so I was just calling up my dad just to kind of talk through some things. And I really appreciate him for saying this. He goes, is there something that I don't know? Is there something that I don't know about this stuff? Because, hey, I'm teachable. I'm open. I want to sit here. I want to listen to what you have to tell me and what you have to say. But nobody has ever shown me where an IUL policy is going to guarantee my cash accumulation and the performance no matter what's going on in the market, and it's always going to appreciate in value. But they can't show it to me because on the guaranteed side of the contract you got these ongoing variable costs of insurance plus this floor that sometimes the insurance agents who are selling these products don't even understand that floor because they're totally neglecting the fact that there's a renewal cost to the insurance there. So here's my advice. If you are the type of person that you are not making over $300,000 a year, you should not be getting into an IUL contract because you cannot afford to absorb the risk when we go into a down market. And I'm sorry if I'm being blunt on this, and I'm probably just beating a dead horse right now, but I need you guys to start understanding this stuff and to help me get this message out there to other people because people are getting brainwashed. They're listening to the noise that's going on out there and they can't think for themselves because they got Billy Bob over here and they got broke ass brother-in-law over here blabbing in their gums all day long. And we need to support our community and guide them in that correct direction. So I want your help. If you are getting into those conversations of IUL for banking, send them this podcast episode. Send me an email, podcast@themoneymultiplier.com. I got a whole bunch of other resources. This is not my first episode that I've talked about IUL contracts on, and it's not going to be my last. And we got a whole bunch of recorded webinars, Noggles, YouTubes, and even our live mastermind events where we've gone into the depths on this. And hey, if you were there in Nashville this past year and saw Mr. Clay Summers talk about UL versus whole life, I mean, was that just not a showstopper, jaw-dropping presentation? I mean, nobody puts it down like Mr. One America who's been there for 40 plus years. But, when you hear these real life case stories of just people who have totally messed themselves up because they didn't understand all of the moving parts and all of that gray area, it's tough. I don't want to get into a situation where I have to sit down with one of my clients and they're 85 years old. I got them into an IUL contract. Market's not performing. The renewal cost of the insurance keeps getting more expensive. And I have to go to Mary Smith and say, hey, Mary Smith, hey, Bob Smith, I'm sorry, but this IUL policy is just not performing how we thought it would. So I'm going to have you come out of pocket with $10,000 to keep this policy alive, or you're going to totally lose all of it. All the cash value is going to be gone, and even that death benefit. I don't want to have those damn conversations with my people, right? And so this is why my sixth point of where we should be keeping the money, if not the infinite banking concept, then what? I want to keep my money stored inside of a protected place where it's going to grow tax-free for me. The government's out of my hair. I have the control, the freedom, the liberty, the justice to do whatever I want with my capital whenever I please. And then also, to add an extra layer, I am now then hedging myself against inflation because of the uninterrupted compounding interest that happens in the policy, and I can still double dip on it and then take that cash value and go put it into other investments, and now I'm making interest in two places rather than just one, right? So this is why we're using a whole life policy contract. Guarantees. And like I said before, I want y'all to keep it simple, keep it stupid simple. The whole life policy is the place to warehouse the money and to protect your greatest asset, which is you and your ability to produce income. I'm just going to do a slight PSA on death benefit. Death benefit is important, y'all. You do need to prepare yourself for the unforeseen circumstances that are going to happen, and you need to protect yourself from you being your number one asset and you to support your family and your livelihood. I'll tell you right now, I have a client. This is actually my first. I'm probably going to get a little emotional right now. This is my first death claim that I ever had to deliver to one of my clients. I've had a lot of clients that, not a lot of clients, but I've had some clients in the past that have passed away. Chris Noggle, Brent Kessler, we had to go out there, Devin Burr, we had to go and deliver some death claim checks. My client, he was 51 years old. 51 years old. Would you ever expect yourself to pass away at age 51? No. Do you think he thought he was going to pass away at age 51? No. Hell no. Not at all. I was talking to that guy almost like every other weekend. We just have these conversations for an hour plus, just going deep and deep and deep into it. And it was just so sad. His wife calls me up and he says, Hannah, he passed. And the sad part about it is that he could not qualify for life insurance. He actually had to put this policy on his spouse because he could not qualify for the policy because of health concerns going on. And she's calling me up now in tears because she's like, oh my gosh, he did all the money stuff in the family. I don't even know how to pay the bills. I don't know who I pay all this to. And Hannah, I know we had conversations with you. I know this policy stuff, but I'm nervous. I don't know how I'm going to keep paying this premium all these years. And it's stuff like that we don't plan for, that we need to start planning for and putting emphasis on. And your death benefit is very, very important, y'all. All right, hold on. Give me a quick moment. Let me go grab a tissue and I will be right back. Hold on. All right, thank you guys. So pardon that little emotional take. But this is why I'm saying that you need to start planning for the unforeseen times. And this is why a whole life policy is so important, because it's permanent insurance and the risk is put back on the insurance company, because no matter what happens, they have to pay me that guaranteed interest no matter what. I get my guaranteed interest, and then the bonus that I receive On top of that would be that dividend. And yeah, I can't sit here and promise dividends because they're not contractually guaranteed. But with all the companies we do work with, they have been paying dividends for over 120 plus consecutive years. So it's a pretty strong chance that they will keep paying out that dividend. And my last topic, I'll touch on this and then we'll move on. But if you run into somebody who is preaching banking, I want you to ask them to just even show you their portfolio. Are they practicing this stuff in their life too? Do they have whole life policies? Okay, you do. What have you been using your policies for? What have you been doing up to this point with it? What are you doing in your cash flow monthly to make you shift from putting money into the policies versus keeping it down at the banks? So have them show you how they implement it. How do they structure their policies? And what have they been doing it up to this point in their life? And it's not about selling a product, y'all. If you want to go sell a product, go buy term insurance. That's a product. It's not a product. This is about the process of our banking taking back the control and then having that permanent guaranteed death benefit. So look, here's the points I'm trying to make. If not IBC, then what? Here's our options. I can keep it down at the bank, where the bankers are using my money and making a good living off of my money. And if you really think your money's backed up by the FDIC, we got to have that come to Jesus meeting right now. So I can keep it in the bank. I could keep it under my mattress where I lose money due to inflation. I could keep it with financial advisor where I have to pay them my fees, my taxes, and I am involving risk into this because it's more than likely probably some stocks and bonds and different things, very traditional investing. I can give it to an IUL, but as we just mentioned, you don't want an IUL product because it is investment, or I can keep it inside of my whole life policies. And whole life policies is just the place that I manage it, I grow it, and I am the one that's in control. And there needs to be a role of ownership here that you need to take, because nobody's going to be responsible for your financial life but you, and you need to start taking that responsibility. So let's just compare two of them, the biggest two that we talk about on this channel, the bank and mutually owned life insurance companies. Here's what I want y'all to do. Take out a piece of paper, and I want you to draw a big T on your chart. Do this with me. Get out a piece of paper right now. Go grab yourself a pen. Pause the episode if you need to. But here's what we're going to do. Write a big T on your paper. We're going to do a big T chart. On the left-hand side, we write bank. On the right-hand side, we write whole life, mutually owned life insurance company. I don't know if y'all can see this, but I have bank on the left-hand side, whole life, mutually owned life insurance company, right-hand side. And we're just going to do a big T chart here, okay? Why do I keep my money at the bank? Or what are the benefits right now of me keeping my money at the bank? Well, the benefits are I do earn interest at my bank account. Let's call it 1% interest. I know that some bank accounts are most likely giving you less. Some of them are giving you more than some of those like 4% savings account that you see now after COVID time, right? But let's just call it 1% for an average. I'm earning 1% in my bank account. And inside my bank account, is that taxable growth or is that tax-free growth? It's taxable growth. So on the bank side, we're writing 1% and we're writing taxable. The whole life side, inside of your whole life policy contract with a mutually owned insurance company, we get a guaranteed interest rate and dividends. Let's call it 4%. So in my policy, I get a 4%. And do you think that's taxable or tax-free? That's tax-free growth. So I'm writing 4% in tax-free on my right-hand side. Check it out. Okay, for my people on YouTube. Now, I do agree that at my bank account and the policy, they are liquid. It's liquid money. My definition of liquid is that I can turn this into cash within 30 days. That's liquid money to me. So on bank side, we write liquid. On whole life side, we write liquid as well. Now, my bank account though, God forbid, if I get sued, I have a judgment lien against me, people can definitely come after the money that's sitting inside of my bank account. Do you think they can come after the money that's sitting inside of my policy? No, because you know what's inside of my policy? It's a protected asset. God forbid if something were to happen and you have a judgment or lawsuit against you, nobody can come after the money that's sitting inside of your policies. Here's a real life example, one that I bring up all the time. Know O.J. Simpson? Yeah, O.J. Simpson. Found not guilty in the criminal trial, but he was found guilty in the civil trial against the Goldman family. Do you think the Goldman family ever got any money? No, they didn't get any money. A lot of people know that. You know why they didn't get any money? Because OJ's money was locked up inside of his life insurance policies. True story, y'all. So, on my bank side, we're going to write not protected. On my whole life, mutually owned life insurance company side, we're going to write protected. We're just making some comparisons right now. What about this? When my time comes that Jesus calls me home, do I have a death benefit on my bank account? No, but I got a death benefit on my policy. And that's a permanent death benefit no matter what happens until I am age 121. Here's some context, y'all. Something that I learned in my earlier days is that if you make it to age 121, did you know that the insurance company will pay out the death benefit directly to you? They basically say, hey, it's been fun hanging out with you and playing with you. You're now age 121. We've been doing this for X amount of years now. And it's the end of our contract, and we just don't want to play in the sandbox with you anymore. So what the insurance company does is they pay you out that death benefit, and then policy's just done when you're age 121. Now, the only downside to that is if you do make it to 121, that death benefit that they do pay you is taxable. But I don't know about you, but when I'm age 121 and I get a death benefit of $5 million, do you really think I give a crap if it's taxable or not? Right? But anyways, just a little side note. So on my bank side, there's no death benefit, right? No death benefit on the left-hand side. Right-hand side, there is a death benefit. And when that time happens, that death benefit is going to get paid out lump sum tax-free to my beneficiaries. Last and final thing, your bank account, not stable. Not stable. Mutually owned life insurance companies, stable. Here's what I mean. I said I wasn't going to get into it today in this episode, but I think I'm going to go down it just a little bit. Why do I call the bank account not stable? Like I mentioned before, if you really think your money's backed up by the FDIC, here's our come to Jesus meeting, and we're going to have it now. People think that when they leave money in the bank, they say, oh, it's backed up $250,000 by the FDIC insurance. Yeah, that's a load of crap. You know, actually, an article was posted back in March of 2020. The Fed, even itself, has to have 0% reserves inside of it. 0%, aka no effing money anywhere in sight. So what happens is that the bankers will take our money, okay, and this is fractional reserve lending. This is what it's called. The bankers will take our money, we the depositors, we keep the money there, right? And when we make our deposits, the bankers are not going to the back and there's a little black box in the back that says Hannah Kessler. They put the money in there and then they wait until I come back and I retrieve that money. No, they ain't doing that, because you know what they're doing? They're lending my money. They're using my money and they're lending it back out to you or to other people. This is called fractional reserve lending. So what they can do is, for every $1 that the depositor leaves at the bank, that banker can now lend out anywhere from $8, $9, $10 for that $1 in their reserves. So essentially at the commercial banks, they have to have at least 10% held back there in their reserves. And they're playing the game. Well, I don't think, and I hope that not everybody in town is going to come and do a run on the banks and request all of their money out at one given point in time. That's their game that they're playing with themselves. And as we know, let's see what happened last year. Silicon Valley Signature Bank. How well did that work out for y'all in 2023 when people came and did a run on the banks? Then what the Federal Reserve System had to do is they had to turn on their printing press and say, hey, bank, don't you worry. I'm going to turn on this printing press. I'm going to give you and loan you more money at cheap rates. We're going to fill you back up again, so then you won't feel the heartache and the pain and the uproar in your town when you don't have the money to give to them. So then what happens is, when the Fed deploys more money, we saw this around COVID time. Why do you see the prices are where they're at right now? But the Fed will deploy the money back into the economy, start circulating around, and that's why we see the prices and this inflation keep going up and up and up. And so, in my opinion, why I enjoy the infinite banking concept is because now I'm no longer contributing to the problem of our economy and the issues that we see here with the fractional reserve lending system. So it's not stable. It's not stable because, let me tell you this. How comfortable and fun would it be if your bank went belly up and then you try to go down, request your money out because you need to go buy food for your family, and the bank turns around and gives you a certificate of deposit saying, hey, I know we have your money. I know you left $10,000 here with us, but we just don't have it right now. So here's a certificate of deposit knowing and honoring your $10,000 deposit that you have with us. How cool is it going to be to try and go and buy ramen noodles and a steak for your family with that certificate of deposit down at Publix or Walmart? You're not going to be able to go do it, y'all. So it's not stable. It's not stable. Where the mutually owned life insurance companies, they operate on that I almost called it fractional, They operate on that Austrian economics principle, where for every $1 that they hold in their reserves, they cannot lend out any more than that $1. $1 has to protect $1 held in their reserves. And they do this because they are not in the same business and lending practices that conventional banks are. They are walking in, they call it a unilateral, I think I'm pronouncing that correctly, failed grammar, okay, but they're walking into this unilateral contract between the policy owner and the insurance company, and they're saying that, hey, policy owner, if you pay us these premiums, we have to, by contract, we have to pay you this guaranteed interest, and we have to pay out this guaranteed death benefit at the time of your passing. And they need to make sure that they are keeping up with their contractual promises of the guaranteed interest and the death benefit that they have to pay us and our beneficiaries at the time of that passing. So they're not walking into these risky lending and business opportunities like banks are, where they're going down and they are, doing mortgages for low income families or doing loans for startup companies and different things. Insurance companies are not doing that stuff. So it's stable because number one, it's just stood the test of time. I mean, again, go back, the whole life policy has been around even longer than the tax code's been here, and they've been paying dividends way longer. So if not IBC, then what? If not my policy and where I safely protect the money, then what? And if you ever forget about this, the reason I wanted y'all to pull out your pen and your notepad and write down this T-chart, if you ever forget about why you're doing this, I want you to take this and I want you to put it on your fridge. Put this on your fridge and remind yourself, okay, this is why I'm doing this. This is why I'm getting into this concept, because I get it. Y'all are not in this day in and day out, maybe like how I am. And so when you get into the normal daily activities of life and you're going about, you're talking with your friends and your family about this, sometimes you can feel like a whack-a-mole character, right? You go out there and you're like, whole life insurance is so great. And then your aunt comes to you, yeah, but you should buy term and invest the difference. Whack. And then you go to like your uncle and you're like, guaranteed interest and dividends and it's all tax-free. Yeah, but you can make so much more money investing in the stock market. Whack. Right? You feel like this big whack-a-mole character. So just know, it's very simple. Keep it stupid simple. These are the principles of why we're doing this, and not just keeping the money held down at the bank, how we've been conventionally conditioned to think. And that's the hardest part, I would say, about this whole concept, not because of the policies, the process, the product itself, but it's you and your sixth law of Nelson Nash of rethinking your thinking. And quick preview, that's going to be next week's episode, is we're going to be getting into Nelson Nash's laws and our human behaviors that we need to overcome to be sufficient within this whole concept. So, last thing I'll say, and then I'll let y'all get going on your days, but the infinite banking concept is a process. It's not about the product itself. And why we're using the policies, among the great bullet points I just gave you in my T-chart, but one of the biggest reasons too is about the opportunity cost of the money, okay? The whole reason that I flow my money through my policies first is because once my dollars hit the policy, now starts that time clock of the uninterrupted compounding that I'm going to get on that money for the rest of my life. So what I'm going to do is I'm not going to change anything that I'm already doing. Keep going out there, making your purchases, make your investments. Yeah, maybe if you want to look at it, cut back, look at your budgeting, your expenses that you are spending. But without getting into those deep weeds right now, we need to understand that our money has a cost to the capital. We either give up the interest we could have earned on it, or we give up the interest by paying it out to other people. So I don't like to go and just withdraw money out of my checking and savings account and paying for things, because then now I'm losing out on the interest that I could have earned on that money. And that's why I circle it through my policy first. Get the dollars in there. I'm going to earn my uninterrupted compounding, and then I'll go buy my investment, pay my taxes, give to charity, pay down my debts, literally anything and everything that you're already doing right now. The same thing comes true with debt, y'all. I mean, the reason that my family started where we were at with Pop's almost $1 million of debt and using the policy for it is because he could have kept continuing on with how he was doing it by just paying cash for the debts. But because he started to run the money through the policy first, he was able to accomplish paying off the debts and was able to recycle and recapture that money back to himself and back to my family. And let me tell you, as being his daughter, I am very grateful and happy for it, because I'm going to take all that money when Pops croaks one day. Not saying that I want him to, but when it does happen, I'm going to take those dollars and I'm going to be doing something for myself in my life, right? And another point too, I mean, oh my gosh, I could be sitting here all day with y'all, but we're about an hour into this freaking thing. But This is why it's important. Bring the money conversation around the kitchen table, teach the children about this, and stop making money such a taboo subject. Thanksgiving just happened. We got Christmas coming up. And let me tell you, I finally, shout out Uncle Brad and shout out Aunt Sandy, okay? And if y'all were down there at our Nashville mastermind event, you met Uncle Brad and Aunt Sandy, but that's where the whole joke of the broke-ass brother-in-law came in, okay? So long story short, and again, this is all giggles, okay? We love each other, and this is all just fun and games, right? But I applaud them because my family has been doing this ever since 2008, right? We heard about it in 2006, but never started till 2008. And Uncle Brad and Aunt Sandy, they've been around this stuff since then. They know what we do. They know the policies. They know our business. But as of this year, 2024, they finally started their first policy. Your friends and your family members are going to be the hardest ones to talk about this stuff to, because if you've ever heard the saying, you can't be a prophet in your own town, that's so true. And I've been seeing it play out in my own life. And it takes a while. It takes a while to rethink the thinking, retrain the conventional wisdom, and stop listening to all the garbage and the noise that you hear out there. Because look, y'all, here's what I think about. I can control one thing only, and that's me. That's what I think, what I say, what I do, my actions. All I can control is me and myself. And if I can control the money and what I'm doing with my financing, my banking needs in my lifetime, I'm going to do it. So now look, I'm always here. I want to be here to answer questions. If you got in-force illustrations that you want me to review, send them over to me, podcast@themoneymultiplier.com. I'm here to listen. I'm here to learn. If you got information that I need to hear that I'm not keen on understanding, send it to me. I'm always open to learning. Never hit the arrival syndrome, but no one has ever showed me why IUL policies have better control and protection compared to a whole life policy. So y'all just remember this last thing. It doesn't matter how much you make. It only matters how much you keep. Stay on top of it. Keep tracking your stuff. I see y'all. I believe in you. Happy December, everybody. I'm going to be back next week with another episode. We're going to get deep into Nelson Nash's laws and our human behaviors. It's going to be a good episode getting into the end of the year to really prep us for 2025, because shit, y'all, 2025 is right around the corner, all right? So I will see y'all next week. I am so grateful for y'all joining me. Hopefully this was insightful. Post your tea charts on your refrigerators, on your dishwashers. Post it up to your mirror in your bathroom when you're getting ready in the mornings, and send me a picture, okay? Reach out to me on Instagram, Facebook, email me. I'm always here for y'all. And I'll see all of you friends in Tampa as well. MoneyGameLive.com. I'm so excited. Let's keep mastering the money game. I'll catch y'all next week. Bye, y'all.